Yes, boy, you moved down again. And the issue is our May reads for ISM services PMIs. And here they are. 49.9. The headline was supposed to come in at 52, expansion territory, but instead it moves to contraction under 50. And the last time it was under 50 was June of last year, and that's when we comp to on this number. If we look at prices paid, the opposite. They're moving higher from 65.1 to 68.7. That's definitely warmer than we expected. That's the hottest prices paid since Nov of 22. But the market certainly seems to be more focused on weakness than the inflationary implications of prices paid. New orders, 46.4. Once again, back in contraction mode, and that's the weakest all the way back since D's of 22. And finally, on the employment front, and this is important because we had a weak ADP, and of course, Friday we have the big jobs report. This one climbed over 50, 50.7, the best since, well, just Feb of this year. But indeed, we retook expansion territory. Now, as we sit at 440, we're literally exactly down a half dozen basis points on a 10. Carl, back to you.
All right, Rick Santelli, thank you very much. Meantime, some new data from the New York Fed this morning. A survey of some 300 businesses found that for those facing tariff cost increases, most passed on at least some of that to their customers, with nearly a third of manufacturers, almost half of service firms fully passing along all tariff costs by raising prices. The others reported they were absorbing some of the cost hikes. Despite the uncertainty around the trade policy, businesses are reacting quickly. Over half of manufacturers and service firms said they raised prices within a month of experiencing those cost increases, many within a day or a week. Something we'll keep an eye on. Again, this is, again, we talk about the shift between survey data and the hard data, but this is certainly one way respondents are talking about what's happening.
I guess we'll wait to see whether it shows up in the headline inflation numbers, because it hasn't yet. We keep seeing softer inflation numbers, and now we're seeing softer job numbers. So that's where ADP comes in today. Private sector jobs read, and it was much weaker than expected. Only 37,000 jobs were added in the month of May. Weaker than expected, and a big step down, as you can see, from April. It's actually the weakest level in 2 years. What does this mean for Friday's jobs report? Well, there's not a really direct correlation. Some people see it as a leading indicator, but it is worth paying attention to because it gives us a snapshot of what companies are doing. And if you break that down further, you can see the job losses really came in the goods producing sectors. That 2,000 negative on that, where services producing sectors were still gaining. That tells you it's about tariffs, right? Because that's where the tariffs are. They're on goods producing sectors. It's no wonder President Trump tweeted, ADP number out, too late Powell must lower the rate. He is unbelievable. Europe has lowered 9 times. If he's making the argument to get ahead of the economic weakness and we're not seeing inflation, these numbers give him further fuel. And so do the recent inflation numbers.
Yeah. Small businesses, firms with fewer than 50 employees cut negative on a net basis. Peter Bookvar with the nice note. Should we really be surprised? Put yourself in the shoes of an employer. You can understand the hesitancy many business people have, especially small businesses that don't have the flexibility of larger firms. But we don't seriously believe that a rate cut now is going to mean anything for months, right? The transmission mechanism takes a long time.
I don't know. I mean, it goes through to the market. I mean, it could definitely, through the you see the 2-year yield moving lower today. That's one of the ways that transmission mechanism is more immediate. Same with the U.S. dollar, which has been weak, and that sort of eases financial conditions along with lower rates. The debate is whether they need to wait a few months to see the inflationary impact or lack thereof of tariffs, or if they're getting what they need right now to say, okay, we'll move a little closer to the cut. Just more granular jobs data, because that is the other part of their mandate. And if it's weakening, they need to be careful about that. But yesterday we got the JOLTS report. So job openings, we're up, we're high. That's good. Layoffs were a little bit higher as well. But how about the quits rate? This is a good indicator, right? So if you feel confident that you can get a new job, you're going to quit your job. So that number was really high coming out of the pandemic, as you can see, above 3, because people felt like there were a lot of job openings and they could go out and get a job. It has steadily come down, and it went down again in last month's number. We're not, in recession type levels here, but it's something to watch as the Fed pays attention to the cooling off of the labor market. And that is certainly happening. We'll see if the jobs report on Friday confirms that. So far, it's been calm, but it's sort of ideal because it's a soft landing. It's not any big drop off. It's not recessionary, but there are signs that things are cooling, and that's to be expected with what's happening with the tariffs.
An interesting chart of lower highs and lower lows. Certainly for more on the market and this morning's data, let's bring in Oppenheimer Chief Investment Strategist John Stolfus here at Post 9. John, it's good to have you back.
Oh, great to be back.
There has been some chatter about, if you look at Q1 GDP consumption got revised lower. Construction spending was weak. ADP today. Are we entering a stretch of weaker data?
No, I'd have to say not necessarily weaker data that should be of overly concern, but we would have to think, much like Sarah was just saying, you've really got, it looks like a relatively soft landing that we're experiencing. And we've been looking for that for ages, because the Fed, raised 11 times, then paused 9 times, began the cuts last September in terms of rate cuts. One cut of 50 bips and then 2 cuts of 25 bips apiece in November and December. We think they're going to cut again probably in September this year. But again, a down payment just to show the market rates are normalizing, maybe 25 bips in September.
When again, though, prices paid on this print, and then the other day on manufacturing prices paid, like above 60 for 4 months.
Yep.
Is that a landing?
No, I think that we don't know really where the landing is, and a lot of that has to do relative to planning that's occurring related around the tariffs, which is still very much unknown where we land. What we have found essentially with Trump 2.0 is he's most certainly, it's not so much that he chickens out, it's just that he responds to the reaction of the markets when it's too hard on the tariff thinking. We've seen that over and over again since the tariffs were placed, much to all our surprise, I think, so high on April 2nd, he's maneuvered. Okay, so,
Market's 20% off the lows that it hit on April 8th after Liberation Day.
Yep.
What does that tell you?
Well, I think what it tells me, if I look at May, the best performing sectors were information technology, communication services, consumer discretionary, financials, and industrials, not necessarily in that order, but they were very, very powerful rallies. And we can't help but think the market is telling us most certainly where it wants to go. And I think it's illustrative to the administration, and that's for their consideration. I think Scott Bessent helps soften the harshness sometimes that comes out of the Oval Office.
Right. John, stick with us. We do have some breaking news. For that, we're going to turn to Emily Wilkins. Emily, good morning.
Good morning, Carl. Well, we have been waiting for this. The total cost for the Trump mega bill. We now have the official scoring for the Congressional Budget Office. $2.4 trillion over the next decade is how much that House-passed bill is expected to add to the deficit. That, of course, comes as Elon Musk called out the bill for adding to the deficit and the debt yesterday, and as senators are trying to find a path forward to the bill. Obviously, costs are one of the things they're keeping in mind, but a number of senators do want to make cuts that would add to the overall cost of the bill. So again, $2.4 trillion over the next decade, going to become a very key talking point up here on Capitol Hill as the Senate works on moving that Trump mega bill. Guys?
Okay, Emily, thank you. Emily Wilkins. John, Should the bond market be concerned about this?
I think it's normal for the bond market to be concerned about this. I think the relative. Now, I couldn't hear what was going on.
$2.4 trillion
Okay,
over the next decade to national debt. That's how the CBO is scoring the latest bill.
I think until we get an idea of what kind of growth the policy that is coming from the administration, how that actually works, it most certainly will be something that keeps the bond market from getting an ebullient spirit. That said, I think for the equity market, it pushes the brake a little bit. We just saw the small and the mid caps look like they went to negative a little bit earlier.
S&P just went negative.
And
it's coming
with
back.
that, but that's very natural. It's the reaction. Traders usually right away they take the negativity and they take it to the nth degree. Meantime, the intermediate to longer term investors are buying the babies that get thrown out with the bathwater almost right on top of it. We've seen that consistently this year.
Over and over.
Yeah. You need to have you have to have either the Pepsi or the Tums nearby with all of this happening. But at the same time, the reality looks like the softer data doesn't, and the projection of negativity is not overwhelmed because the fundamentals remain remarkably good.
Right. Well said, given 3% from the highs on the S&P. John, thanks. See you soon.
Thank you.
John
Great being
Stolfus.
on with you.
Here is our roadmap for you for the rest of the hour. Is the U.S. headed for an economic crisis? Bridgewater's Ray Dalio joins us with his warning for the market and how to fix it. Next.
Senator Warren's with us, slamming the Fed's decision to lift that asset cap for Wells. We'll talk to her about that news and a lot more.
And shaping up for an IPO. We'll talk about the upcoming listing of stablecoin issuer Circle, which is expected to price tonight. Big show still ahead. Stay with us. Squawk on the Street. We'll be right back. Dow's up 16 points. Elon Musk blasting President Trump's big, beautiful bill on X, calling it a disgusting abomination of pork-filled congressional spending that will burden Americans with crushingly unstable debt. And as we reported just a moment ago, the CBO out with their estimate saying that the tax cut and budget bill would add $2.4 trillion to the national debt. Well, our next guest has a brand new book out this week all about the topic of debt, and it is making the rounds in Washington. It's called How Countries Go Broke, The Big Cycle. And joining us now is the author, Ray Dalio, founder of Bridgewater, one of the world's largest hedge funds. Ray, it's good to have you. Congrats on the book.
Thank you.
So is the U.S. going broke?
Yeah. The reason I wrote the book is that for about the last 50 years, I've been an investor who has bet on bond markets, and I've been through plenty of these debt crises. They happen over and over, and they're not understood mechanistically. So the book, the purpose of the book, is to explain the mechanics of how this happens as it applies to the United States. And so I'd love to just take a minute and explain the mechanics of how that happens, if I can.
Yes. I mean, we do. We get the headlines every day on the high debt and growing debt load. So tell us what we need to be aware of.
Yeah. In other words, why now, not another time? Is this a false warning? What happens? Okay. I just want to convey that. There are three things that happen. When you could think of the credit system for the government as being very similar to your own credit system, or if you're running a company, what it's like to run a company in debt, except for two different things. They can print the money and they can take the money from you through taxes. But the economics, the debt is basically the same way. And so think of the circulatory system like there's this great circulatory system that brings credit to people. And then if they use that credit well, they produce profits, and the profits pay for it. And so if debt is rising relative to income, that's a problem. And so what happens is mechanistically is first that as debt and debt service rise, then the debt service, the interest rate, and the debt payments increase and squeeze out spending. And so you're seeing that. In other words, you're seeing, I'll go into the numbers in a second. I'll just get the three forces. The second force is a buying and selling. In other words, the one man's debts are another man's assets. So they're holding these bonds. There's so many people who are holding bonds around the world, the debt holders, and that they then take those bonds, and if they now have to buy a lot of other bonds because we're selling those bonds. Not only is there a supply-demand problem now, if I actually calculate who are the buyers of those, there's a reducing demand relative to the supply, and if you get into a position where they have to then worry about those bonds, they could sell those bonds. So the amount to be sold, it can be much greater even than the amount of the new debt that's being produced, and there's a supply-demand problem. So the second factor is the supply-demand, and the third is when that supply-demand problem happens, either interest rates go up or the central bank comes in and prints money. So if we go through those numbers, I can take you through them pretty quickly. You can see the position of the U.S. and the problem emerging.
Right. No, and all good issues. And I think it's why you have people like Jamie Dimon coming out and saying we're heading toward a debt crisis, and why Elon Musk is so worried about the debt. The biggest question I have, Ray, is how urgent of an issue is this? Are we actually seeing evidence about what you're talking about happening?
Yes, it's urgent. It's urgent because we are on the brink of the supply demand. Just to put it in perspective, imagine you're running an enterprise, a company. You're spending $7 trillion a year. You're taking in $5 trillion. You have a $2 trillion deficit. You have a debt that's 6 times the amount of money that you're taking in. The interest on the debt is $1 trillion. That's 20% of all your spending and 50% of your deficit. And you can't cut the costs materially. You can't cut the costs because Social Security, all of these things are not.
It's political.
Okay, so you have a real problem. You're at a juncture.
Oh, no, go ahead.
You're at a juncture where you have to borrow money to pay your costs. That means that you're at this point where as the debt then compounds on the debt and it's squeezing out, it's 50% of the deficit. So it's going to squeeze out. You'll have a supply-demand problem. So if we go another year and a year after that, which is probable, it's probable that nothing materially will be done until after the midterm elections. You're going to then have a different set of circumstances. You have more debt that you have to compound, still no plan to deal with that debt, and you have a political situation. Should you have a recession, it worsens, because the recession not only makes people more confrontational, but it also raises the budget deficit. It's the biggest influence in the budget deficit. So it's very urgent to be able to deal with this consideration now. It was dealt with well. There was a cut of 5% of GDP. If they can cut from the targeted 7% of GDP to about 3% of GDP, in other words, a cut of about 4% of GDP, not only are they going to have budget benefits, but they'll have lower interest rates, which contributes to better balance. That was done between 1991 and 1998. So there's a path here. I call it the 3% three-part solution. 3%, get the deficit down to 3% of GDP. Spread it out. That means you probably have to change revenue and taxes, tax revenue and expenditure by about 4%. Squeeze in 4%. And if they do that, they will have probably a 1 to 1.5% decline from interest rates, and that will reduce the deficit by nearly another 2%. And that would be the path. That's what I call the 3% three-part solution. On both sides of Congress, I've spoken both sides, agree on the numbers and agree on the mechanics.
No, even Scott Bessent, the Treasury Secretary, talks about 3% deficit to GDP. I mean, they want to go there, but they're trying to pass a bill that adds $2.4 trillion over the next decade to national debt.
So what it's like is on really between 1991 and 98 as a general example. In the book, I give several examples of how to do it in this balanced way.
Do you think that the dollar's reserve currency status is genuinely threatened right now by this fact and by the risk you're laying out?
Yes. A debt and a currency is a medium of exchange and a storehold of wealth. We store it in a debt. And if there's a depreciation in the value of the currency, there's a depreciation in the value of the debt. And because there's a need, because there's this problem and these imbalances and so on, this is a big issue. So the depreciation of the dollar is making, and the expectation of a depreciation of the dollar makes it less attractive to hold that. Now, there are by the way, most countries around the world right now are dealing with this. Europe has a debt problem. Japan has a debt problem. China has a debt problem. So what happens is that all of these countries have this problem and will probably depreciate their currencies in a sense together, very similar to the 1970s. While the dollar in the 1970s fell against the alternative currencies, and it's probably likely that this happens again, you also have all the currencies falling in relationship to gold, goods and services, and so on, and then you can have an inflation. The problem you also have to worry about is when the government, the Federal Reserve, buys the debt, it takes a position in that debt. When it starts to lose money in that debt, then it has losses. It can have a negative net worth. That's the situation now. Then you get into the need to monetize the debt. These are the things to be careful about, and that's why it's been repeatedly. In this book, I covered 35 examples of the mechanics. And so that's the mechanics that we're dealing with.
So It's clear, you make it very clear what politicians need to do, and I think that they will find this book helpful, and hopefully they'll be able to get a hold of it. What about investors? I mean, it sounds like you're making the case for gold here and why you've liked it for a long time as a diversifying asset. But what should investors do? Should they stay away from U.S. bonds? I mean, we did see the 30-year yield cross 5%. I wonder if that's an indication that the dynamic is changing.
Investors need to have a diversified game plan. I'm not trying to get them to time the markets and move in and out and so on. The most important thing is that they have a well-diversified game plan. My own view would be that debt is going to be a problem. We have too much debt. We're going to get a lot more debt. So debt assets as a general thing is something to be worried about. But don't go whole hog in anything. But it is true that if you were to take a balanced portfolio and say, does gold serve as a diversifier? I think it's going to be a good asset, but it also is a diversifying asset, not a lot. Maybe that's 10% or 10 or 15% in a portfolio. It's an effective diversifier. I think the key at this time is we're going to become in a very risky environment, not just because of what we're talking about the debt, but we have a great deal of internal conflict between the left and the right and what's going on. We have a changing world order in which there's external conflict between countries. What is the world order like? And then we have other things developing. So I think we're going to be in a period of greater than normal risk. So when you start to think about what is the best portfolio that's a diversifier portfolio, the power of good diversification in reducing your risk without reducing your returns is a great power. So I would encourage the understanding of proper diversification with a bias to stay away or shy away from debt assets.
And what about equities then? Because if what you're talking about comes true, it feels like it would be very risky for all U.S. assets.
In real dollars, yes. It depends how bad it gets. If it gets to be like the 1970s, it would be bad for all the assets. But the gold portion, or maybe to some extent a Bitcoin, depending on where you're thinking, or whatever that inflation hedge asset, will then go up in that environment to provide some sort of a diversification. So if you have a balanced portfolio that way, and you get into a type of 70s, what happens for just depreciation of the currency up, if it's not a lot, it actually is supportive to equity prices. The problem right now is that if you look at equity valuations, they're relatively high in relation to bond valuations. Yes. That means if interest rates go up, it's bad. It's very bad for both of those markets. So the Fed will have to come in. But that diversification would be the main thing I would emphasize.
Well, Ray, it's great having you on the week that the book is out. It is a very timely conversation with what's happening in Washington right now. Thank you for the time.
Thank you for having me on.
Ray Dalio, book is How Countries Go Broke, the Big Cycle. And I've been told that lawmakers are taking a look at that. And I think that the discussion is live right now as they're talking about the big, beautiful bill and whether they have the political stomach to actually cut. I mean, you can't really cut those numbers unless you're talking about entitlements, Social Security, Medicare. That's tough stuff.
Right. There's the tax cuts, too. There's both the revenue side and the spending side. Still ahead this morning, Wells Fargo shares moving higher on news the Fed is lifting the bank's asset cap. But not everyone's happy about the move, including Senator Warren. She is going to join us live in a First on CNBC interview. Coming right up.
The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default.
Welcome back. Let's get a CNBC News update with Silvana Hanau. Hi, Silvana.
Hey, Carl, good morning. A U.S. and Israeli-backed aid group paused distribution today at its 3 sites in Gaza amid safety concerns. There have been a series of shootings as thousands of people flocked to the Gaza Humanitarian Foundation distribution points, including one yesterday that Red Cross and UN Rights Office says killed 27 people. Israel's military said troops fired on people who approached its forces and ignored warning shots. Closing arguments are picking back up this morning in Harvey Weinstein's sex crimes trial. Prosecutors argued yesterday the movie mogul used his power and influence to trap and abuse women, while the defense claimed the women accusing Weinstein are lying. Jurors are expected to begin deliberating this afternoon. And the Department of Transportation warned this morning it is likely to take back $4 billion in funding for the $128 billion high-speed rail project in California. In a more than 300-page report, the Federal Railroad Administration cited several issues, including budget shortfalls and questionable ridership projections. California now has until mid-July to make its case to keep the funding. Sarah, I'll send it back to you.
Okay, thanks, Silvana. Yeah. Senator Elizabeth Warren calling out the Federal Reserve for lifting Wells Fargo's asset cap, saying the bank has, quote, a long history of violating the law and there's no evidence that it has changed. She joins us next to discuss. And do not forget, you can catch Squawk on the Street anytime, anywhere. Just listen to and follow the Squawk on the Street podcast, which is available on Spotify, Apple Music, and more. We're back in a moment.
now and make it count.
Welcome back. Wells Fargo stock moving higher this morning after the Federal Reserve Board announced it was lifting a cap on the firm's assets that had been put in place all the way back in 2018 in the wake of the bank's unauthorized account scandal. Senator Elizabeth Warren, in a statement calling the decision by the Federal Reserve Board, quote, an outrageous giveaway to one of Wall Street's most derelict banks, adding Wells Fargo has a long history of violating the law and there's no evidence that it has changed. Well, here's what the CEO of Wells Fargo, Charlie Scharf, said last hour on CNBC when asked if he had spoken to Senator Warren and other critics.
I try and talk to everyone on both sides of the aisle. And by the way, I understand criticisms that people have had about us in the past. In fact, I would agree with many of the criticisms. What I hope is that they would look at the work that's been completed, the independent work done by the regulators, again, the majority of which, and the conclusions likely reached under a Democratic administration, and say, this is the way it should work. The regulators actually at this point should be congratulated for driving the fix. I mean, I and the management team did a lot of work, but they're the ones that drove this and were the ones that oversaw this and made sure that we and our board were doing all the things that we should have done.
Joining us now, first on CNBC, Senator Elizabeth Warren. She's the ranking member of the Banking Committee. Senator Warren, good morning. It's good to have you.
Good morning. Good to be with you.
Why not just take the win? I mean, this was a harsh punishment that encapsulated the better part of a decade, identifying the problem and systematically fixing it.
Well, if they had systematically fixed it, then I'd be happy to take the win. But in fact, every member of the Fed should be embarrassed by what they've just done. Look at Wells Fargo's record. You remember what happened 7 years ago when they get caught in a scandal that is so terrible, it in fact involves criminal penalties. And they set up their whole business operation around cheating their own customers and cheating their investors, and they got caught. So they end up with this penalty that there's going to be a cap on how much growth they can engage in. And what do? Do they clean up operations and say, that's it, we're never going to break the law again? Nope. Not only have they continued to break the law, look how recently they have done it. In January of this year, the SEC tagged them for scamming their own investors. In December of just last year, what would that be, 6 months ago, the CFPB tags them for more than $800 million scam involving Zelle and their customers. And then last September, the Office of the Comptroller of the Currency tags them for money laundering. And as if all three agencies tagging them for serious violations of the law just in the last 9 months is not enough. In April of this year, just weeks ago, former and current Wells Fargo employees actually put out a report that said Wells is engaging in the same behavior that they were engaging in 7 years ago that started this whole cascade of law breaking, and that Wells Fargo hasn't really changed. I'd like to see Wells go just 1 year without a serious violation of the law before the Fed says, okay, we're good now.
Well, I mean, we could go one by one on all of those, but many of them were not consent orders and not related to the fake account scandal, which is what ultimately had them in the consent order. I'm just curious, Senator, have you read the 20,000, I'm told, pages of documents that they had to provide, not just to the Fed, but also to an independent verification on this that allowed them to get this consent order?
So that is the perfect question. And that is exactly what I have asked for. I want the Fed to give the Congress, the Banking Committee, 5 years of bank examination documents. I want to see what it is that Wells Fargo represented to the Fed and what the Fed asked Wells Fargo. Remember, the oversight job in Congress is both for these giant financial institutions, but it's also oversight over our regulatory agencies, including the Fed, to make sure that the Fed is doing its job. So that's what I'm calling for right now.
I think it's hard to release it to the Congress
so that we can read it.
I think it's hard to release to the Congress because I think there's probably a lot of proprietary confidential information in there.
You can release it to the banking committee. We have a great deal of experience in dealing with confidential information and not leaking it. We've done it before. We can certainly do it
again. So are you saying you don't trust the Fed?
Our oversight responsibilities. I want to see 5 years of bank examination reports from the Fed. I want to see how the Fed made the decision it made, given that Wells Fargo continues to break the law.
Vice Chair Barr, I mean, is someone that I think that you supported, and he's a tough cop on the banking beat. He led this. It was a unanimous decision by the Fed board. And again, just to go through some of the fixes, since you raised the question about the fixes, they did miss out on $9 billion of earnings a year, according to Bloomberg. They spent more than $2 billion a year on risk controls and completely refreshed their management team. I think 80% or more turnover on that front. And simplified their business by selling or closing 13 businesses. It's not like they were just marching in place waiting for this to end.
But notice what you're doing. You're saying engaged in lots of activities. What I'm looking at is stopped breaking the law. The point of engaging those activities is so you have appropriate safeguards in place so that you don't break the law. They get caught by the SEC, they get caught by the CFPB, they get caught by the OCC, the three big banking regulators breaking the law just within the last 9 months, plus a report from
They're
their
not the
own
only
employees.
ones. They're not. Cities had Bank of America. This is why they are heavily regulated.
Then we need oversight of all the banks, but particularly, particularly we need oversight of Wells Fargo. Because even when it is under this kind of scrutiny, it still has engaged in activities where it has broken the law and done so repeatedly. That's a real problem with a big financial institution. And look, the problem with the Fed governors, I want to be clear, every single one of them should be embarrassed, whether they're Democratic appointees or Republican appointees. And that's why I want to see the bank examination reports. Show your homework to the Bank Oversight Committee in confidence so that we can see the decision that you made and what went into that decision and what changes Wells has actually made.
Is there a part of you, Senator, that would actually welcome a more robust competitor in credit cards or in wealth management or in commercial banking?
Yes, I would like to see a robust competitor who follows the law, yes. I think it is unfair to those who are in any business if they have to compete with people who cheat.
You say in your statement there's no evidence that it has changed. Have you engaged with the bank itself? Have you talked to management? Have you been inside of there?
I am open to speaking with anyone, but be clear about this. It is out there in public when they have broken the law, and their own employees and whistleblowers are saying they're engaging in the same activities that got them in trouble 7 years ago. I want to see how the Fed arrived at its conclusion.
I guess I'm just, from what I've been told, that you actually have not engaged with them. I mean, if you have such strong concerns about the management team, which is completely refreshed and has done a lot, I'm wondering why you won't meet with them.
I have expressed my concerns repeatedly and openly. And anyone who thinks I haven't expressed those concerns loudly enough, believe me, I am happy to repeat them again. Look, I'm open to meeting with anyone, but I don't want to hear a bunch of happy talk. I actually want to see the documents. I want to see what information was provided to the Fed that made the Fed, despite all of this public law-breaking activity, made the Fed to say, looks great, we're done here. I want to see what the Fed based that on.
The Fed and a Fed-approved independent third party, I would also note.
Well, fine. Then what's the problem with sharing it with the people whose legal responsibility is oversight of the regulators who are making this decision? Just show me your homework.
While we have you, I'd love to get your thoughts on this new CBO score and Elon Musk's commentary about this abomination, as he called it, and whether or not that moves the needle for some Senate moderates.
Look, you'd have to talk to the Senate moderates about what moves the needle for them. Right now, they seem to be fine with cutting health care access for 14 million Americans and cutting access to food, and pairing that with tax breaks for billionaires and millionaires. And look, I'm pretty straightforward about this. I don't think any little tiny baby ought to have to go without health care so Jeff Bezos can buy a third yacht. But I do believe that billionaires ought to be paying their fair share, and that failure to do that is a problem in our national debt, and it's a problem with this budget that the Republicans are moving forward. And it's just interesting to watch all kinds of different people come out of the woodwork, including your previous guest, say, you can't keep doing this. You can't hand out those kind of cuts to billionaires and still sustain the economy. That's going to create a problem for everyone. And look, here on Capitol Hill, the Republicans can do whatever nonsense they want to do and pretend that this is not going to cost money. But the reality is, and the markets know, that if you're not bringing in enough revenue to cover your expenses, that's going to be a real problem. And the bond market is starting to show that. So I'm very concerned about where the Republicans are driving this. They can't get where they want to be because they need magic math to be able to fix it. And you may be able to sell magic math on the floor of the United States Senate to the Republicans, but you can't sell magic math to the American people, and particularly to Wall Street and the bond markets.
So Democrats are deficit hawks now?
No, that's not the point. The point is that you cannot cut health care in America so that billionaires can get more tax breaks, so Mark Zuckerberg can buy another Hawaiian island. And you particularly can't do it when the giveaways to the billionaires are so ginormous. That is going to blow a hole in the United States budget. And that's what people are telling you from the left, from the right, from the center, from people who don't even like politics. And the Republicans in Congress can deny that, but that is the reality on the ground outside that building.
Just to put a final point on the Wells Fargo and just regulating banks in general, Senator Warren, a lot of folks in the banking system will say, okay, mistakes have been made, but that the regulators are there. And actually what this is a really effective display of what it looks like to have pretty hardcore regulation that spans both Republican and Democrat administrations and also third-party regulators. And they're regulated on some of the issues you talked about as well that have happened since then. The question is, do you worry at all about the unintended consequences then of, it putting even more regulatory pressure on these banks, which are critical for our financial system, providing liquidity, providing loans? Do you want to see that in the hands of crypto firms or others that are less regulated?
I'm sorry, you're throwing a giant parade and tossing confetti over regulation that, let's see, what's happened in the last 9 months? Wells Fargo has been tagged for money laundering. It's been tagged for being engaged in consumer fraud, and it's been tagged for cheating its investors. Man, I don't know about you, but that doesn't sound like to me really tough oversight and a celebration of what a great job the oversight folks have done. They've caught Wells Fargo breaking the law over and over and over. And now everybody wants to celebrate that that's all behind us, and it'll be just fine to turn down the regulations on Wells Fargo. I just got to say, that makes no sense. But if the Fed has an argument to make here, then the Fed should release those banking examinations for 5 years to the banking committee and let us look at their homework.
All right. Senator Elizabeth Warren, thank you for coming on with your take.
You bet.
We appreciate it for the time in Washington.
Meantime, watching some sectors this morning, especially the tech trade, the best performing sector since the start of Q2, up around 15% since April. Best performers in the space are Palantir and Broadcom, both up 50% since the beginning of the quarter. Also, keep an eye on HPE, moving higher today. Stocks off the initial highs, but that did follow the big earnings beat from last night. Speaking of which, do not miss a First on CNBC interview in the next hour with Antonio Neri of HPE. That's when Money Movers begins in just about 6 minutes.
Stablecoin issuer Circle set to make its public debut this week, aiming for a valuation north of $6 billion, looking to raise $896 million in this IPO, which is actually up from the $624 million it was initially seeking. The plan is to offer up to 32 million shares priced between $27 and $28 a piece. They'll be listed here on the NYSE under the ticker CRCL. And per the filing, Kathy Wood's ARK has indicated interest in purchasing up to 150 million of the shares. This would make Circle one of the most prominent pure-play crypto companies to list on a U.S. exchange and a test of overall appetite of stablecoin as well. Jim Breyer's been a longtime investor. He's always loved this company.
Meantime, Money Movers is up after this. Don't go away.
51. Now, America's premier crypto. DC+.
Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks not too far from all-time highs. At the same time, the economy showing some signs of weakening. We'll tell you what that's all about. We'll discuss and debate and how to navigate these markets with the investment committee. Joining me for the hour, Joe Terranova, Jim Leventhal, Sarat Sethi, Bryn Talkington. Dow's going for a 5-day win streak. ISM non-manufacturing PMI below 50. That was notable. The lowest ADP print in more than 2 years, notable. Yields falling, something to keep an eye on. The president, once again, all over the Fed chair to cut rates. ADP number out. Too late, Powell must now lower the rate. He's unbelievable. Europe has lowered 9 times. At the same time, Joe, the president says it's extremely hard to make a deal with China's President Xi. You have the drama over the tax bill. You have the Musk versus Republicans on the Hill now. Ray Dalio on CNBC earlier today agreeing that the debt's a big problem. Nothing new from him, of course. He said, quote, "We're going to be in a period of greater than normal risk," citing a number of factors for that point of view. And yet the S&P is 2.5% from a new high. And I think our viewers care more about that than any of the other surrounding noise, I dare to believe.
I would agree with that. And everything that you're identifying is going to be featured on the next episode of how the market continues to move higher. Because in the current episode right now, the market is running off of a rebuilding of sentiment and positioning. And that is absolutely what is driving the market in the near term. What you've identified, the concerns that are in front of us, the concerns surrounding, absolutely, there is a hesitancy to transact. That was clear in the month of May. It is reflected in the services. It is obviously reflected in the ADP report. And tomorrow we're expecting 130,000 jobs in the May report, down from 177 in the month of April. I think we're going to see that there as well. So in the near term, the market has the ability to move towards the all-time highs. I acknowledge that. But I do see in the third quarter, there is difficulty ahead, and it's related to an economy that is going to cool. And I've said this for the last several weeks. My biggest concern is not inflation, it is growth. And I am concerned that growth is slowing rapidly.
Well, and I guess you have to be concerned that the tariffs are the contributing factor or the leading factor as to why growth would be slowing. You know, I don't know what you guys think about what the future of the tax bill means to the future of the market.
I think it means a lot.
How are you thinking about that?
Here's my opinion, and we wrote this at Cerity Partners. It's up on our website. That the CBO, the Congressional Budget Office, which scores this thing, says it's going to be $2.4 trillion over the next 10 years, $240 billion a year in deficit increasing. But there's two things that are left out of that. One is the fact that the CBO does not do dynamic scoring. It doesn't take into account any economic growth that may come from this. We're of the opinion that there will be economic growth that comes from this.
Well, the other side of this equation, I'm sorry to interrupt you.
Are you going to steal my thunder?
I'm sorry to interrupt you, is that they also came out, because Megan Casella was doing this reporting earlier and saying that they said that the tariffs would cut the deficit.
Thank you.
However, okay, let me finish, because there's a big asterisk by this second one. They say it would cut the deficit, the tariffs would, by $2.8 trillion over 10 years. So let's just call it a net zero. That is assuming, of course, that the tariffs are in place for 10 years.
Yeah.
Anybody believe that you're going to have tariffs in place for 10 years?
I hope not.
Well,
listen, wait a second. You're even debating that they could be?
No, I think, 10 years. I mean,
That's what they said.
I know.
That's what the scoring is based on.
That is what the scoring is based on. I mean, I think all of us on this desk and the ones who are not here today will admit that it's a difficult job to predict what the rest of this year is going to bring, let alone 10 years. We have to deal with the cards as they're dealt, and you just showed them to us, Scott, and that's what I was going to say, is that right now, in the month of May, tariffs ran at an annualized rate 190 billion more than a year prior. That's just a fact, okay? So that 190 billion up against the 240 billion of deficit increasing, again, not dynamically scored from the deficit. I call it a wash. Will it last? I don't know. I don't know if the tariffs will last. And I think, frankly, what I'd like to see before we discuss whether they last through next year's midterms is let's get them in place and move forward. This economy, this world wants to know what the rules of the road are, corporate-wise, investing-wise, and move forward.
It still leaves you, even if it is a wash, it still leaves you with the current state of the deficit, which is not good.
Okay,
not today, but tomorrow. The trajectory that
you want me to say the quiet part out loud?
Yeah, go ahead.
Yeah, the way you get out of this is not austerity.
You grow your way out of it?
You grow your way out of it. I mean, and I'm sorry, there's a little inflation involved in that too. That's the quiet part out loud.
Well, I mean, that's clearly their belief, is that you can deficit spend your way out of it because you would ignite a level of growth that would eat into the deficit and get it off of this train wreck trajectory.
No, I mean, that's the key question, right? As to if the growth is there, and I think the leading indicator is going to be the bond market. And when your 10-year is now 4.4 and kind of on the cusp, when you were talking about this tax bill, if the tax bill comes as where it is, the 10-year might move up, and that will have an effect on the stock market. So in the short term, I think you're going to expect a lot of volatility.
Bryn, how much of this matters? The market knows a lot of this already, and as I said, we're 2.5% from a new high on the S&P. I think there's like trade war fatigue, tariff fatigue, warning fatigue, Diamond Dalio. It's like, okay, we get it. Yeah. We're 2.5% away from a new high on the S&P. Can we get there in the face of all of that noise?
As long as the bond market lets us get there. And I think that's where ultimately that will be the the judge and jury around deficit spending and what the market is, the bond market, not the stock market, will I think, solve that equation. Obviously, you have Ron Johnson, Rand Paul, other senators that are saying, are doing the work that we're all talking about. And so I think the bond market is what to watch. But I do think this wall of worry we're climbing, that we're a whisper of at an all-time high. I think that I'm in the consensus, which makes me a little nervous, that everyone feels like we're in this range-bound market between 5,750 and a little bit over 6,000. And so I do still think, though, that the pain is on the upside, because people, I'll say, not retail investors, not our clients, but a lot of people, institutional investors, are underinvested. And so we'll see what happens. But to me, I do think we have trade fatigue, absolutely. And I will say, within the numbers, what we haven't talked about are the JOLTS numbers, that the JOLTS numbers actually yesterday came out better than expected, or however you want to look at it. And so unemployment is low. There were more job openings than were expected. And so as it relates to, Trump and Powell, I just think he's barking up the wrong tree. There's really no data that says that he needs to cut right now. And the tariff uncertainty is just going to even push that out further, unfortunately.
Right. Well, I mean, the person's policy is the thing that's lighting the fire that's hurting the economy, and that same person wants the Fed to come to the rescue of the policy that has caused the uncertainty to begin with. I mean, that's the irony, obviously, of the whole thing. Irrespective of any of that, I don't want to spend the next 20 minutes talking about trade, tariffs, and all that other stuff.
Okay, let's not do that. Because
I think there's, we're 2.5% from a new high on the S&P. And technology has been ripping. That trade is back in a very big way. And so if I think we're getting to a new high, where do I want to ride that? What's the goal here?
Well, that's the current episode of how the market gets to the all-time highs. And it is really predicated on, first and foremost, the momentum factor. I think I've come on the show multiple times in the last week and talked about names like Netflix making a new high, like Axon making a new high. I talked about Dash yesterday as a final trade. So it is very much the same equity names that are powering the market higher. What we're benefiting from is, in addition to those names like Broadcom, which is moving higher today, it is semiconductor names that have not participated over the last 3 to 6 months. It's semiconductor names in which positioning was reduced dramatically. The momentum factor moved away from the KLA Corp, the Applied Material, the Lam Research.
But there's momentum back in the semis. Semis are up.
The momentum is back.
Semis are up 15% over the past month.
So there is near-term momentum back in the semis, and that is what the market is benefiting from, in addition to the momentum names that have been there for the last 6 months. Now you have the added benefit of, okay, let's go back into the semis. So I keep suggesting it's very important to watch the semis. This afternoon's Broadcom report is very important. Does capital go out of Broadcom into a name like AMD, which has struggled over the last 6 months? Can the semi momentum carry forward over the next several months? And if it does, it's one of the primary catalysts, and we'll look back and say that's one of the reasons why we achieved all-time highs.
I mean, it's semis up 15% over the past month. Cloud up 9%, cyber up 8.5%, a new record high today. Software, Brin up 5.5%, and technology far and away the leading sector group over the last month. Even as some try and suggest that the rally's complacent on both fundamental and technical grounds, I don't know. What do you think?
I think that you want to kind of build on Joe's momentum area. If you look consistently, what the areas you named are all above the 200-day moving average versus a Google or a Salesforce or an Apple or healthcare, which are all under the 200-day moving average. And so I think you've got to stay with who brought you to the party, and not only with the momentum names, but I feel like those companies and those sectors that are above the 200-day moving average, if we do get any pullback, which doesn't look like it right now, those are going to be the sectors and securities that continue to march higher. And so I think that's where, once again, Apple well below it, Google well below it, those names are going to struggle versus the Netflix, the Metas, et cetera, that are well above that very simple but important 200-day line.
Sherrod, I feel like if not everybody, certainly the majority and most of our viewers are thinking the same thing or wondering the same question. Is this market on a trajectory to continue to go up? Is there enough momentum to have a little bit of a sizzle here in the summer for stocks? Or is the you-know-what eventually going to hit the fan from the tariffs? And now if there's drama extended over this bill, whether that's going to cut into whatever momentum seemingly existed for this market.
Yeah, I think you have to break it up into two parts. I mean, the momentum stocks, the ones Joe's talking about, have earnings growth behind them. So right now, as the market is moving, the money is flowing to earnings growth that we see in the next couple quarters, as opposed to the uncertainty as to what's going on in some of the stocks that, like the Googles of the world, where, you know, growth is slowing. However, what could happen, to your point, is if we get too much of this negative news, the macro effects, the algos come in, and you just get equity selling a broad base. So that's when you pick up even more of these growth companies, because they're on sale at that point, even though they have growth.
It's not just a growth conversation. I mean, if you, like Jim, is probably more positive on the state of the economy than anybody on the panel, certainly today, then you must think that other areas of the market are going to work and get you to those new highs, even if maybe tech doesn't have to. It might.
Well, I think I'd take your words and I'd rephrase it this way. I think it's a stock picker's market. I mean, we often say that, but I do think, and we're all saying, I think the same thing, that the market will set a new high, maybe goes a little further. So, Scott, maybe we get a 5% rise from here in the S&P 500, and then it consolidates over the summer. I think you can find stocks out there that might do 10% in that environment. I've added to a couple of them today, Cisco Systems and Qualcomm. You know, Surratt was just mentioning about positive earnings growth. What I also look for, and I know Surratt does as well, is positive earnings revisions. Cisco, if you look at the earnings revisions, is definitely going higher, and it's with good reason. If you've listened to their last several earnings calls, they are definitely benefiting from AI, definitely benefiting from the data center build out, and it's just not reflected in the multiple. With Qualcomm, it's a little bit different in that the earnings revisions are very slightly upwards, but they're being anticipatory, and I think those earnings revisions are going to start marching higher, not on the back of cell phones, which we all know waiting for this much heralded super upcycle is not happening, but where Qualcomm's going to really get the earnings revisions upward is in automotive and Internet of Things, the latter of which also does play into the data center build out. So my point being is that you can pick stocks and not have yourself involved with this discussion about whether the market's too high or it's going to hit a new all-time high. You can pick stocks.
The payoff and all that, you didn't mention those two names by accident as we have on the screen. You bought more of both.
Yes, I'm sorry. I thought I said that, but yes, thank you for pointing that out.
That's what I'm here for.
Thank you,
Please,
Scott.
go ahead.
You know, I'll also Stacey Rasgon yesterday had a research note in which she called Qualcomm the Rodney Dangerfield of semiconductors, and they get no respect. I'm not sure everybody listening.
Qualcomm's one of our largest holdings, and it hasn't really gone anywhere. But what you're also getting through is this overhang period of every time people talk about, well, Apple's going to do this and Apple's going to do that, you're going to get secular growth out of Qualcomm in other areas that are not just dependent on Apple, and that's the thesis of that one.
You trim some Microsoft at the same time.
You got to find money with which to put the new money to work in Cisco and Qualcomm. And I looked at Microsoft. It's had a fabulous run. I still own the stock. I'm not saying anything terribly negative, but at 31 times forward earnings, I think it might be at fair price. So if I look for a source of funds, Microsoft is the one.
Amazon's target today in that group gets raised to 240. JP Morgan. Meta's target gets raised, JP Morgan, to 735 as well. So there continues, Joe, to be optimism, and a lot of it around these names. That,
there is.
If analysts missed the last run in May, which was so significant, they're going to chase it up even further.
They are, but let's keep in mind, right now, of the 11 major sectors, technology is running in 8th place. I know recently we have a revival for semis in some of the Mag 7, but so far, year to date, it's been industrials, financials, utilities that are carrying the market higher. As it relates to the Mag 7, the strongest momentum that I see in the near term, and even if you pull back the calendar over the last year, is certainly with Meta. Meta is up 16% year to date. It's up 6% in the last 5 days. Sorry, Jimmy, I'm seeing very strong momentum momentum for Microsoft, which is pressing towards an all-time high and looks like it wants to break out above there.
It's only 1% away.
Yeah, and you see, remember, positioning is so important in these names. You see rebuilding and positioning here in Microsoft because let's remember, it struggled. It had the relative underperformance last year versus the other Mag 7.
Well, we could turn now to Apple because a reminder, Monday, of course, is the Worldwide Developers Conference, so we're going to be live there for both halftime and closing bell. We'll have several guests on site, and it really does come at an especially critical time for Apple. Over the next 3 days, we're going to look at the most pressing items that Apple investors need to hear. What does Apple really need to address? We're going to tell you that, as I said, over the next 3 days. Well, that man right there is Steve Kovac, is thinking about this in a special report. Tell us.
Yeah, Scott. Well, let me give you those 3 things to watch for. We're going to be talking about this the rest of the week on your program. What's Apple's AI strategy now? What's it going to do with AI search, which has been teased a little bit by executives the last several weeks? And what can Apple offer developers to keep them in its ecosystem? Now, WWDC is coming after that failure to execute with Apple Intelligence, which was unveiled at last year's event. And just now, this just came in, Scott. The Financial Times reports Apple Intelligence's approval in China is now being held up because of the trade war. Now, since last year's WWDC, they have indefinitely delayed the AI upgrade to Siri, took Siri away from AI boss John Gianandrea, ChatGPT integrations there, but it's kind of lacking the service's best features, and other AI features just aren't that impressive. You know that because, well, when was the last time you got one of those Genmojis sent to you by one of your friends on Apple Intelligence? Look, the real kicker, despite the hype around Apple Intelligence, it did not drive iPhone sales in a significant way as so many people predicted it would. So, as for a clear AI strategy, not expecting a ton of fireworks here next week at WWDC, but the most notable one, Bloomberg reporting that developers will be able to tap into Apple's AI technology for their apps. But as we all know, Apple's AI models are not as powerful or as robust as those from OpenAI or Google or Meta and so many others. Apple's going to have to show developers that they have the advancements that can keep them in Apple's AI ecosystem instead. Now, tomorrow, Scott, we're going to dive into AI search and who Apple may be partnering with there after missing big time on that Siri AI update, Scott.
You get a feeling that inside that building, that beautiful building out in Apple Park where this is all going to take place, that they're feeling the pressure of what didn't take place over the last year since we sat together at the prior WWDC?
Yeah, they have to. I mean, part of the reason that Apple Intelligence dominated last year's event, Scott, was because they were perceived to be behind in artificial intelligence after we saw so many of their peers and competitors put out just this huge cadence of products and innovations, one after another, especially at OpenAI. And then you have the Johnny Ive thing that happened with OpenAI. That partnership, that puts more pressure on Apple. It also puts pressure on OpenAI itself. So, and then look, let's even rewind 2 years, Scott. 2 years ago, they announced the Apple Vision Pro, that new headset, the new big computing platform that launched to so much hype, and that has really failed to take off. So they're coming off of 2 really tough years where they kind of didn't deliver what they said they would, and so the expectations here are pretty enormous for them to show us stuff that is actually going to launch. But right now, expectations are relatively muted, so we'll see if they can kind of turn that around. It's a good chance for them to reset the narrative, especially on AI, Scott.
All right, we'll see you tomorrow with part 2, as again, we do a 3-part series here leading up to this incredibly big event for Apple, where once again, we'll be live from WWDC at Apple Park. Live coverage is starting at noon Eastern. Steve, thank you. Let's just go through, Bryn, this downgrade today one more time from Needham on Apple. It's to hold from buy. They removed the $225 target, and they do it because they say on a number of fronts. Threats to Apple's near-term revenue and EPS growth. Every big tech competitor wants to take Apple's 15 to 30% platform tax. Gen AI innovations open the door for new hardware form factors that threaten iOS devices. And Apple trades at a forward year 26 PE of 26 times, which looks expensive on several metrics. Any one of those might be concerning. Taken in total, and there's the analyst who did it, Laura Martin. She's on the exchange at 1 o'clock today, so you can get more detail from that. But what about this call?
I think it's a little bit late, we'll say. The stock is not even near 225. But I think that the first point about the threats to revenue and earnings growth, like I cut half the position back in December because it's like, what revenue and earnings growth? The only earnings growth we've seen is because when their earnings per share come out, their per share number is lower. The denominator is lower because they're buying back so many shares. The challenge is there has not been revenue and earnings growth. I do think the app platform fee that they're charging, to me, that is the biggest risk because those services, that is a huge cash cow for them. I think what happened with Epic and with games, I think that is a risk in the name. And it's the 225 is actually its 200-day moving average. I think it's a good call, and I just don't see the catalyst to get this stock going again versus the other names like a Meta or an Amazon that you just like consistently are just running on all cylinders, moving in this direction and executing. This is a hardware company that to me has a software problem.
Yeah. Speaking of software, I do want to hit our chart of the day. It's CrowdStrike. We're going to pivot there because it's down significantly today. And if we talk about it 10,000 times on the way up, that everybody loves it, we're going to talk about it on the way down, Joe. It's down 6.5%. George Kurtz is going to be on with Jim tonight on Mad Money, so you want to check that interview out. What's the deal here? Why is the stock down 7%? If for other reasons than it had been straight up and to the right to a new high, as we pointed out, I think yesterday, if not almost every day recently.
Well, you can't dismiss that because when a stock goes up so significantly and you know that positioning is full, you need to see an earnings report and guidance that really blows away consensus expectations.
Is that the problem? The guide was weaker than expected?
I don't know that any of it was bad. I think it was a really good report. I just don't think it was an overwhelmingly great report. And I actually think it's somewhat healthy that it corrects.
ISI says, Evercore ISI downgraded it today, and they said it's a full valuation.
I disagree with that. I think this company is in the sweet spot, as is most of these cybersecurity names. I own the company personally, and I've said I'm maintaining it for long-term positioning. I'm not going to have a reflex reaction to a earnings report based on one quarter that I don't think was troubling. I just think positioning was very full, and you needed to blow out the numbers.
Isn't that the same thing? I mean, if positioning's full and the valuation's full,
work off the position.
Why does it have to be anything wrong with the report? Maybe the report was just fine. But I mean, if the valuation, yeah, but the stocks just don't go up into the sky forever.
Of course they don't. And that's why I'm saying this is healthy, because a lot of times when positioning is full, you have hands that are involved in a particular equity name that are not comfortable maintaining positions, and you need to kind of work that off. Positioning is so critically important. I'm not saying that this was a fine report. It was okay. It needed to meet and go beyond the wildest expectations to go even further higher.
All right,
what you're seeing is healthy.
All right, coming up next, after this quick break, we're going to trade committee stocks that have been on a hot streak. Well, I mean, for the most part, there are some losing streaks that we need to get to as well. We're back after this.
never gets boring.
Said top of the program, we are really not that far away from a new high on the S&P. 75 S&P stocks have hit new highs since the April 8th low. They've not only come all the way back, they've hit new highs. 18 today, as a matter of fact. Lots of stocks have been on hot streaks. Church & Dwight is up 7 days in a row, Joe.
Consumer staple name, exhibiting strong growth. And interestingly enough, you're seeing that momentum funds are allocating in the direction of consumer staples. A lot of the reasoning behind it is because of the success previously allocating towards Walmart, allocating towards Costco. Now you have new names like Church & Dwight and Monster Beverage.
Visa, Surratt, a 6-day win streak. It is a new record high for shares of letter V.
I mean, this is a stock when you see more spending coming, and if you get inflation in the system, they make money. It's a toll. So their multiple is going to keep where it is, and the earnings are going to keep on growing as long as we have some inflation in our system.
It's interesting. Everybody owns this. Bryn, why is Visa doing so well?
I mean, they're out of the crosshairs of the tariffs, but I mean, we've talked about this before. High margins, no capex. This is an asset-light company. They have a duopoly basically with MasterCard. And also, as it's making new highs, there's a really good rule to remember. Don't short a stock making 52-week highs, and don't buy a stock making 52-week lows. So I think this stock on momentum alone is going to continue to go higher.
Jimmy, Wynn is on a 5-day losing streak.
Yeah.
Uber is as well, but we did that yesterday.
Well, let's do Wynn.
And I'm Ubered out. I won't win. 5 days down in a row.
It's stuck in this channel from a technical point of view. It's stuck between 80 and 100. And I mean, if you stretch that channel out for a couple of years, that's a long channel. I'm not a great technician. Joe, you may have something to say about this. That's fine. Not the dinosaurs in the desert thing. But when you get this long of a channel, it's breaking out one way or the other. It is. And I'm telling you from the fundamental point of view, not just of what Las Vegas is doing and what Macau might doing, but the growth properties in Dubai, some other things they may do internationally, that I very strongly think that the breakout is to the upside when it happens.
Down 15% in the last 5 years.
Okay, I mean, look at this chart. Like, pull up a 5-year chart.
Jimmy's already said he doesn't care about past performance.
Come on, it's in a channel. It's in a channel here, and it's going to break out one way or the other. Now, if you honestly think, and this is fine, if you think that there's going to be a recession out there, we're going to start parking planes in the desert, we're going to be laying off staff at Wynn Resorts, then it's going to break to the downside. You know my economic point of view. That's not my economic point of view.
Your Honor, can I respond?
Go ahead.
Down 20% last 10 years.
Okay, I haven't owned it for 20 years. I haven't owned it for 10 years.
He doesn't care about what a stock's done for the prior 10 years.
But unless that I know, unless that sound dismissive as a value investor, and this applies to Cisco and Qualcomm, which I'm building up more now. You build these things not knowing when it's going to hit. I don't know when it's going to hit. Obviously, I thought Wynn would have taken off a long time before this. And I'm sorry, Scott, I say this a lot. It's why you build a portfolio. I can't tell you when Wynn's going to hit. That's why I have a lot of other things in there. A Wob Tech. But Cisco's actually been doing well. Citigroup, you name it. But that's why you build a portfolio, because they're all not going to work at the same time.
Jimmy, if you're in a channel for that long, you send up a flare.
So Equinix is up 6 days in a row, as is Workday, Surratt. Both of those are yours.
Both of mine. Equinix is a data center play. And when you get more money, and you get Amazon announced today, more money coming towards data centers, Equinix is in the sweet spot, and you're going to see earnings momentum there as well. And Workday is just coming off a bottom. They had a quarter that they disappointed, but it's a great company that's got really good secular growth, and I think it's a core holding that you want to own.
Joe, Zoetis is up 4 days in a row. Amgen is as well. Aflac, Amphenol, Lilly, Marsh & McLennan. Amphenol hits a new record high today. All of those stocks are yours.
Some of those names, those healthcare names, Lilly, getting a little bit of a bounce, but I've said over the last week we're seeing momentum deteriorate there. Zoetis is a new position that we've taken, getting some positive momentum. Amgen as well. One more name I'd add there. Take a look at Viva Systems. That's a healthcare software name. That today made a new 52-week high.
All right, let's get the headlines now with Silvana Hanau. Hi, Silvana.
Hey, Scott. Good afternoon. The FBI arrested a man at New York's JFK airport overnight in connection with an explosion last month at a fertility clinic in California. And that's according to NBC News, which reports investigators are looking into him to see if he helped provide materials for the bomb. Authorities say the man suspected of setting off the bomb at the clinic died in the explosion. Ukraine's president is proposing a ceasefire between Kyiv and Moscow until the country's leaders can meet. Volodymyr Zelensky said today he is ready for talks from Monday onwards in Istanbul, the Vatican, or Switzerland. Russian President Vladimir Putin said he doubts a summit would be possible following Ukraine's recent attacks deep inside of Russia, which he called crimes against civilians. And the United Nations Security Council will vote later today on a resolution that demands an immediate, unconditional, and permanent ceasefire in Gaza. Diplomats say the U.S. is likely to veto it. The resolution also calls for the immediate release of all hostages held by Hamas and demands an immediate lifting of all restrictions on aid into Gaza. Scott, I'll send it back to you.
Silvana, thank you very much. Silvana Hanau up next. Santoli, he's here with his midday word when we come back.
Now.
We have some breaking news. Steve Kovac has that for us. It's related to CrowdStrike, Steve.
Yes, Scott, we just got this SEC filing from CrowdStrike where they say they've received requests for information from the Department of Justice and the SEC related to last summer's outage. You might remember that took down pretty much every PC around the world here. And they're saying this is related to what they call the company's recognition of revenue and reporting of ARR, that's annual recurring revenue, for transactions with certain customers. They also say they They expect to incur significant legal expenses as they go through this. Keep in mind, they're also going through that legal battle with Delta and maybe some other partners as well. We don't see shares moving too much on this. The move that you're seeing right now in cross-select shares, that's all about yesterday's earnings. Shares barely budging on this notice. But again, that big fallout from last summer's outage, Scott.
Yeah, I appreciate that, Steve. Thank you. Also glad that Steve reminded us the stock was under pressure already, long before this news hit the tape. Mike Santoli's here, our senior markets commentator, for his midday word. What do you make of the action today?
Running into a little bit of a headwind on the softer economic data. It's sort of just challenging the market's ability to look through it. I guess it's hard to say exactly when you kind of have picked the bone clean in terms of big investors feeling like they need to re-risk this sort of positioning squeeze that's been going on. That's been able to happen largely because you have had more reassurance that the consumer's okay. And, you know, even Jolt's data yesterday was fine. So you wouldn't overreact to the ADP and the ISM numbers today. ISM still kind of fits into the soft rather than hard data category. But I think that's where the market is. It's sort of up here, a few more things have to go right. It can't just be, we're kind of working off the negativity of that shock.
It's interesting to watch the grind of the bond market.
Yeah.
One moment concerned about the deficit, the next moment concerned about growth.
For sure. I guess that's the perpetual pendulum in the bond market. My take has always been it hasn't been as concerned about the deficit as maybe people had made it out to be with the longer end yields going up as much as they have. But this definitely shows you're going to get traction if the cyclical, headwinds pick up or if the perception that they are. Also, with the jobs number coming on Friday, I do think, it's like how negative do you want to be on bonds going into what could be an unpredictable print?
Yeah. And how much cred the market gives to that number based on what was happening over the last 30 days in the month of May.
Right. So we've been feeding off of this period where the data were de-risked because, it's sort of either it's before tariffs or it's pulled forward or it's in limbo and it's not yet affected by what's going to happen policy-wise. So, yes, it is true. I don't know that they're going to overreact to 1 month. But again, after we've had this nice run, we almost get back to the highs and, it sort of has to give you a little bit of an excuse to back off a little bit. But really, this is nothing. I mean, the market has really could have won back the benefit of the doubt, especially the momentum and mega cap side of it.
All right, good stuff. I'll see you on closing bell. It's Mike Santoli coming up. Calls of the day, including a very bullish call on a stock that's already trading at all-time highs. We'll debate it next.
written.
Welcome back. Our friends at Golf Channel are up north this week for the second oldest non-major event on the PGA Tour. The RBC Canadian Open gets underway tomorrow. NBC Sports reporter Kira K. Dixon joins us live from Ontario with what to expect this week. Hi, Kira.
Hi, Scott. Yes, as you mentioned, there's plenty of history here at the RBC Canadian Open. Been played on the PGA Tour since 1904, and TPC Toronto at Osprey Valley is playing host for the very first time. We've got 21 Canadians in the field, but we also have the Masters champion in the field, Rory McIlroy, making his first start since a tied for 47th finish at the PGA Championship. Now, if you remember, he did run into some challenges that week, both on and off the golf course. He elected ultimately not to speak with the media. He also had some challenges with his driver, but he's been spending the last couple of weeks getting back to baseline. Someone else in the field is Robert McIntyre, the defending champion. Now, if you remember, last year he created one of the most heartwarming moments on the PGA Tour when he won for the very first time on the PGA Tour with none other than his dad, Dougie, on the bag. At the time, Robert was going through some emotional things when it came to making the transition to the PGA Tour, figuring out life in America, and he said, you know what, Dad, why don't you come over and caddy for me? Caddy for him he did, to the point of winning. I asked Robert if Dougie was going to be back on the bag this week. He said, no, absolutely not. That's far too stressful. And something that is a little bit stressful coming up for all of the golfers is the U.S. Open next week at Oakmont. This is Last Chance Saloon to get your preparations done for the third major championship of the year. Rory McIlroy was just there actually on Monday. He told me that it is going to be an absolutely brutal test. He thinks that even par is probably going to be a great score, but all you have to do if you're in the field is just practice some acceptance.
Well, he's won this event twice, in 19 and 22, and I did see that he met the media, or at least he spoke today, which normally, as you said, wouldn't necessarily be notable other than for the fact that he didn't address the media at all following what happened at the PGA. And then, of course, he took a little bit of controversy, I suppose, for not playing Jack's event last week, the Memorial, and not telling Mr. Nicklaus that he wasn't coming either, which became its own talker in its own right, Kira.
Yes, that's right. Well, I spoke with Rory about these two topics, and he told me when it came to the Memorial Tournament, first of all, that's something that he decided on for his schedule earlier in the year, that he was always going to miss the Memorial Tournament because he wanted to make sure to be able to play the Travelers, which is after the U.S. Open. If he had had the Memorial Tournament on his schedule, that would have meant 4 weeks in a row. And he said, look, I'm not 25 anymore. I'm 36. I can't be playing 4 weeks in a row anymore. So that's why he decided to prioritize this week. A place that you mentioned is a two-time winner. He loves the RBC Canadian Open. Then he has the U.S. Open, then Travelers to follow up with that. When it came to the driver, yes, we didn't have an opportunity to hear from him about that at the PGA Championship. And what he told me about that was that he didn't want to speak about anything negatively, that it was quite a negative situation. Also, he wasn't playing his best. So it all added up to him deciding to take a step away from the media that week. He also told me he was trying to protect some folks. When that driver testing is conducted, those names usually are kept confidential, and his name was the only name that was leaked. He told me that annoyed him, and ultimately he decided to take time away from the media, and he did speak today on the topic and answered questions both for me, for Canadian media assembled, and for the press conference for the general media as well.
Yeah, he's a huge draw. A lot of eyeballs, obviously, are going to be